So, you want to be a real estate investor, but where do you start? How do you know what information and sources to trust? That's where I come in. I'm Jonny Cattani, and this is the Investor Relations Real Estate Podcast. Hey guys, real quick, before we start, go to investwithcattani.com and download my free ebook, Is Commercial Real Estate Recession Proof? Now to today's show. What's up, guys, and welcome to another episode of the Investor Relations Real Estate Podcast. I'm your host, Jonny Cattani. My guest today truly needs no introduction as he is a household name in the industry, but I am joined today by the great Yonah Weiss. Yonah is a powerhouse with property owners' tax savings. As business director at Madison SPECS, a national cost segregation leader, he has assisted clients in saving tens of millions of dollars on taxes through cost segregation. He has a background in teaching and a passion for real estate and helping others. He's a real estate investor and host of the top podcast, Weiss Advice. So very excited to have you today, Yonah. Thanks so much for joining.
Pleasure is all mine. Well, not all mine, but I am greatly pleased to be here as well, John. So appreciate you having me.
Awesome. So this is one area that I'm just starting to get into. So again, very excited to jump into it. But before we do, kind of give us the Reader's Digest version of, where you started and what led you to this specific niche.
Absolutely. I started out as a teacher for many years, about 15 years. I was doing that and loved it. Still am a teacher by nature. I have 6 kids, so you're always teaching whenever you can, every day, all day. But I got into real estate about 6-7 years ago when I was looking for something more, just more income, more wealth building, and just realized that the teacher's salary was not cutting it, and the growing family, it just needed to do something else. So I reached out to some friends and who, were successful in business and just said, hey, what ideas do you have? And real estate was a very common theme. And so I got involved as a broker for a little bit, residential, then doing some commercial mortgages, just brokering, that kind of stuff. And just learning the industry of commercial real estate was fascinating from the first day that I really got introduced to it by some friends. And after about a year or two of doing kind of a bunch of random things, just learning, really making a little bit of money, but not really enough, I was introduced to this company, Madison Commercial Real Estate Company I'm working for currently, in their division of Madison SPECS, which is the largest national cost segregation company. I found it very fascinating. And what fascinated me the most immediately was the fact that this area, cost segregation, at least back then, 5 years ago, when I first came, nobody knew what it was. I was like, I don't really know what this is. I knew what depreciation was. I understood that, but I never heard of this thing. And I kept asking people around, asking my friends, colleagues, people who I'd met in the real estate business for the previous year and a half, 2 years or so. And nobody, almost nobody, even heard of it, let alone understood what it was. So to me, that was like a light bulb moment. I was like, okay, here's maybe an opportunity to teach me, why aren't people doing this, or why do people not know about this? And it was just the lack of education, I think, a lack of awareness, and especially people who are starting out in real estate. There were no courses that were talking about this on Bigger Pockets. Wasn't even, there was very little discussion around this. And so I just kind of filled that void, really. And that's kind of how I got involved. And it's been a great ride. And I think I should update that intro because it says tens of millions. I think it's up to hundreds of millions at this point of dollars helping save people.
Wow. Casually, just. That's awesome. Cool. So you had mentioned that, just lack of education. So, you call yourself the cost segregation king. So it sounds like you kind of led that education and were kind of that thought leader in getting people aware of this. And then did it just kind of take off? All of a sudden everyone wants it, or was it kind of a slow progression?
It was definitely a slow progression. And I think the Cost Seg King, just the brand, the awareness, and the social media presence and being on a ton of podcasts helped. Obviously, much better ring than like Cost Seg Professor or something. That's yes. That's really what I was. I had, just going on tons of podcasts, doing webinars every week, and just letting people know and reaching out to tons of clients and going to conferences, just making it aware. And slowly but slowly, like people started learning about this. And obviously it wasn't just me. There was a big help with the Tax Cuts and Jobs Act back in 2017 and 2018 that introduced this new law of 100% bonus depreciation that got a lot of publicity. And so everyone started talking about cost segregation. And so that really just helped, I think, added to it.
Totally makes sense. And we'll kind of jump into that because I definitely want to speak more on that as well. So I guess let's kind of jump into then now what is cost segregation? Kind of give a high level explanation and what it means and what it means for investors.
Absolutely. So it's a tax strategy. Essentially, whenever you buy a property, besides for your personal residence, if it's a business or investment property, you're able to take a tax deduction called depreciation. Okay. Cost segregation is really just an advanced form of depreciation. And it sounds like, depreciation, it's going down in value, right? That's the definition. But really what it means is it's a borrowed term. It means that based on the principle that things go down in value as time goes on, the IRS gives you an income tax deduction that you can take on your property based on the purchase price and based on the day that you buy the property. So it's a really interesting thing. I say it's a borrowed term because it really is. Your property, maybe the intrinsic value of it, the replacement cost could be like $100,000, but it could sell for $1 million. And so therefore you're able to take the $1 million as a tax write-off. Okay. And that's what depreciation is. And it's done over a long period of time for residential properties, including multifamily. It's done over a 27.5-year period. Again, a really arbitrary number. I don't know why they came up with that, but for commercial properties, it's over a 39-year period. So essentially you're taking that value that you bought it for and taking a tax deduction every year for that long period of time, a little bit. So about a 2 to 3%, if you do the math, deduction of the property value when you bought it every single year. Cost segregation is an engineering method that allows you to take these tax deductions at a faster rate. So by breaking down the property into its components, and it used to actually be called component depreciation. Okay, we're able to depreciate the individual components and say, oh, there's certain things that depreciate on a 5-year schedule, not 27 or 39-year. You can actually take the deductions of those components at a much faster rate. And so that's really beneficial when you can front load, and you have this pool of potential deductions over a 39-year period or whatever, and you can actually pull from that pool of potential deductions and then take them this year. And so that's really what this strategy is all about.
Absolutely. Okay. So that really plays into sort of the essence of time value of money and allowing you to take more upfront, which of course we would all love to be able to do. 100%. And this allows that. So you kind of alluded to sort of this engineering term. So from what I understand, it requires a pretty robust team. So kind of talk about, the makeup of the team and what their roles are.
Absolutely. So even though it is a tax strategy, right, and depreciation is a tax deduction, and that goes on your tax return. However, it requires to do this, the IRS has what's called the Cost Segregation Audit Techniques Guide. And so it breaks down exactly what you need in order to do this. And so you need an engineering company or a third-party company that really breaks down, an engineer that's trained in not only building or construction engineering, but also the tax code to know what all the individual components of a building are made up of and what the value of them are. So we have a team of engineers, we have a team of accountants that's focused specifically on this, overseeing it and doing the calculations. And so that's really what makes the magic happen and I call it magic really because that's what it is. It's like, it doesn't make any sense why the IRS would give this deduction in the first place, but it's allowed. And not only that, it's actually considered the proper way, the correct way to depreciate your property, meaning you're supposed to break down the individual components and say, well, the wallpaper or the carpeting or the cabinets or furniture, appliance, all those things actually depreciate on a 5-year schedule. You're supposed to come up with that. But since it requires a third party, the IRS does not require you to do that. You don't have to go out of your way, right? They don't require you to go out of your way to hire someone to do this so that you can take these extra deductions.
Got it. So does this involve every time you're doing this study actually going on site to each individual asset and breaking it all down?
Yeah, exactly. So the engineer component is the most important part of the process. Madison SPECS been in business for about 17 years, and the business model has always been, we have a team of engineers. At this point, we have about 17, 18 full-time engineers on staff, and they would go and just travel. We have them placed in different places around the country, but they still travel, go on-site visits. However, with the onset of COVID, what we did was transition and kind of pivot, as everyone was, into doing as many virtual site tours as possible, meaning with the help of someone on the ground where it's feasible. It's not always going to be feasible, but with the help of someone on the ground, like a property manager or a maintenance person, someone that's there that can actually have a video call that our engineer can be on the other line and record that and just kind of do a walkthrough and record that video. It's as if they were there. So they're able to capture everything as if they were to visit and take their own pictures, just guiding someone else through that. So that's something that we've done. Obviously, like I said, many properties you can do that with. Certain types of larger commercial buildings, it's really not feasible. So we still need to send our engineers on site.
Fascinating. Okay, that makes sense then. Obviously, having to, the whole world, I guess, sort of had to solve that problem. So makes total sense as to why you had to do that as well. So you mentioned before the Jobs Act, bonus depreciation went from 50 to 100%. We're now in the last year of that 100% bonus depreciation. So kind of talk about bonus depreciation and where it's headed.
Absolutely. So Tax Cuts and Jobs Act 2018, 2017, really the end of it, introduced this thing called 100% bonus depreciation. It previously only existed for new construction projects. Okay. So if you built a new building, you could take 50% of those construction costs that depreciated on a faster schedule, and then you could take that upfront as 50% of that upfront. What the bonus depreciation, the law changed that not only on new construction, on any acquisition, you buy a property, you can not only take 50, you can now take 100% of that. So that allows you to, once you've done a cost segregation study and allocated and found those things that depreciate faster, again, it's only on those components of the building that depreciate less than 20 years, which is everything we're finding on a cost seg. So you have 5-year property that's considered personal property, meaning anything that's inside that's non-structural. And then you have 15-year property, which is outside, land improvements, mostly landscaping, pavement, concrete, all that kind of stuff. So when we've identified that, you now have the option to take 100% that entire amount upfront as a tax write-off. So it can be sometimes 20, 30, 40% of the total purchase price that you can take upfront. As you mentioned, 2022, when that law came into being, it was only on the books to work through the year 2022. So this year, 2022, is the last year that you're able to take 100% of that bonus depreciation. Going forward, it's going to start reducing or phasing out 20% a year. So 2023, it's going to go down to 80%, which means you can take 80% of those deductions in the first year. The remaining 20% of those accelerated components can be taken still over the cost segregation, the 5-year, 15-year, the relatively faster schedules. And then it's going to phase out year by year until there's no longer, at least in the current iteration of the code, it will no longer be available.
Do you see that changing? Are there talks of that already being discussed, or what's the future for that?
Well, there's definitely been talks about it. Unfortunately, there haven't been any real legislative talks or changes. However, a lot of people, from what I understand, especially in terms of lobbying and groups like that, if there is a change in legislation in 2022, which it sounds like they're very well, maybe, especially on the congressional level, then there may be some changes. There may be some extensions to that bonus depreciation. Obviously, it was something I believe that contributed to the economic growth over the past several years. So, it doesn't just affect real estate; it really affects so many industries across the board.
Because this is something, if I understand correctly, that you can apply to, like you said, multiple different, not just assets, but segments of, kind of the society as for lack of better terms, I guess.
Yeah, well, everyone is connected to real estate in some way or another, and this can apply to retail. You have restaurants, you have grocery stores. You don't necessarily think of everyone as a real estate investor, but the doctor and the lawyer or the dentist that own their practice and they own the building, right? They can use these deductions as well. So it was put in there, as well as many other things in that tax reform, to help spurred the economic growth, and it really did an incredible job up until recently, obviously.
Right. Of course. Makes total sense. Okay. So along those lines, you mentioned, doctor's offices, different things like that. Are there certain asset classes that this works better for or makes more sense for, and others that don't, like maybe industrial, or, kind of talk about some of those things?
Every type of property can benefit from the cost segregation. So like I said, if it's an investment or business property, but there are certain that have more components or more things in the building that actually depreciate faster. So for example, you mentioned like a warehouse or an industrial building will have much less, because there's really it's mainly just structure. You will have some land improvements. You'll have a lot of times, some of the ports or the shipping docks and things like that, or you'll have parking lots. All that concrete outside is 15-year. That's land improvements that can be depreciated faster. But inside, you maybe have some shelving or lighting and things like that depreciate faster, but much less than, let's take another extreme, like a hotel or a assisted living facility or multifamily building where there's tons of furniture, there's tons of appliances, there's tons of equipment. All of that depreciates, right? The FF&E, furniture, fixtures, all that depreciates at a 5-year schedule, faster rate. And so there's a large amount. There are certain kind of unique asset classes that have like off the charts amounts of accelerated depreciation, like mobile home parks or RV parks or golf courses. And all those three have one thing in common, is that the majority of what you're buying is actually land improvements. Okay. So land itself does not depreciate. You always have to subtract a certain amount from your property that goes to land. Okay. And that can sometimes be 10, 20, 30% of the total value. What your purchase price is being allocated to land. That part does not get depreciated, but the land improvements, right? Anything on top of the land. And those examples I gave, like an RV park, something that just came up recently in conversation this week, it's just pavement. I mean, unless it's literally like a campground and it's dirt, right? You're not going to get much from dirt because it's really just land. But if it's paved, well, then that's what you're buying. You're buying the pavement, right? And the concrete and picnic tables, all that stuff is land improvements. And so that can depreciate faster. And so whereas on a warehouse, you may have something like 10% of the property can be depreciated faster. On a multifamily, you may be somewhere between 25, 30% can be depreciated faster. Mobile home parks, RV parks, you're looking at 50 to 80% of the property can be depreciated faster.
So even something like, which is necessary, of course, by law, like a parking lot, right? Having to have a certain amount of parking for your tenants, just by pouring the asphalt, now that is able to be depreciated in these studies, is what you're saying.
Exactly.
Okay, got it. And then is this pretty, so like, let's say a C-class property in Oklahoma City, is it a pretty similar study to like a B-class property in like somewhere in Florida, right? Like, is multifamily pretty similar in the way that it's done? Or is it, you have to go on site and you have to see everything just to be sure?
Well, either way, we have to go on site and see everything to be sure, because there are nuances. There are things, obviously, the year built does make a small difference. The unit count, the unit layouts, right? Obviously, there are certain types of properties where there's multiple buildings on site. There are certain types that have, the garden style, where you'll have much more landscaping, or, a swimming pool or playground equipment, things like that. There are nuances to each property. There are more similarities than there are differences, for sure. But we're still going to make sure that we're going to look at every property, the difference. The one, I'd say, biggest difference from a cost segregation perspective, when you're looking at multifamily, or two big differences where it can make a huge difference, is when you're dealing with like new construction Class A properties, because there's so much value placed in the new construction in the actual structural components, right? The building itself is brand new. So there's a lot of value. What we're doing in the cost segregation is taking that purchase price and then reverse engineering all those individual components to add back up to that purchase price, right? We find out how many cabinets, what's the square footage of LVP flooring, how many, et cetera, everything in there, and then add all that back up. Well, when you're dealing with the building and the structure is brand new, it has its full value in it. So more is automatically going to be allocated to that building, to that 27.5-year per property. Whereas on a C class or something like that, you'll maybe have less value in the building itself, which can be more value into those, appliances or furnishings, et cetera.
Got it. Very interesting. Okay, so it's a very nuanced and detailed
Extremely.
study from obviously as what you're explaining. So that makes total sense. Okay, so now let's break it down to the investor level. What does this look like for investors? You know, I know for some investors it makes a lot of sense, for some it doesn't. So kind of talk about, you know, where investors can really take full advantage of this, and in some places where it just makes no sense for them at all.
So from an investor, and when you say investor, I assume you're meaning like a passive, like a limited partner investor.
Let's break it down to the limited passive investor.
So the great thing about depreciation is that, like we said, it's a tax deduction, which means that you can use that deduction to reduce your taxable income. Okay. So if you make $50,000 and you have $50,000 of deductions, you can reduce the taxable income, pay zero taxes on that income. What it won't do is necessarily create a refund. Okay. It may, but that obviously depends on the situation. However, with depreciation, okay, rental income and real estate income is treated differently than your W-2 or other type of income. So it's on a Schedule E, which is considered passive income. And so it's treated differently than your Schedule C or your W-2, right? 1099, whatever that income is. You need to know this because this is really important. Depreciation is limited to be used against your Schedule E, against your passive or real estate rental income. So if you have a lot of properties where you have investments, you're able to use depreciation from one property to offset the income from all the others. But beyond that, there's going to be limitations. Okay. So if you make over $150,000 of adjusted gross income, you basically can't take any of that against your W-2 income whatsoever. There are a couple exceptions. And this is really important because if you're a passive investor and you're being sold that you're going to get all these extra losses and all this bonus depreciation, well, think about it this way. If you put $100,000 into a property and they're saying you're going to get 100% of that back as a tax deduction in the first year, you're like, wow, I get a $100,000 tax deduction in the first year. That's awesome. But what they don't necessarily tell you is that it's only going to be applied to your, $8,000, 8% preferred return income from the property itself. And the extra $92,000 is just going to be passive loss. It will carry forward to the future. You can't use it. The exceptions to that are, and the reason why this is so important is because there's something called a real estate professional. Now, the sponsors, the people that are running the deal, and if you're a real estate broker, or if your spouse is, okay, so only one of you needs this status. And this is like the golden ticket of taxes, because you're able to then not have those limitations, meaning you can use these depreciation deductions not only against your rental income or your passive income, but also against any other source of income, whether it be W-2 or your spouse's W-2, et cetera. So it's a really powerful strategy if you are a real estate professional. Let's say you're a realtor, you're a broker. You need to be investing in rental properties so that you can get this depreciation, because you already get that benefit that you can use it against to reduce or offset your income. So this is a huge benefit. Otherwise, there are limitations. And unfortunately, if you're just strictly a passive investor, you're probably not going to get a lot out of the depreciation, at least as much as people may be selling it as. It will carry forward again. And so you can use it in the future, and you can use it in future years, or you can use it when you sell a property, right, to use those losses to offset, passive gains, et cetera. But you have to know there are limitations.
Got it. So along those lines, would you say, it sounds like that's probably one of the biggest misconceptions then with cost segregation and bonus depreciation. Are there any other misconceptions, kind of with it, or?
I would say that's the biggest misconception from just a regular, not from the investor standpoint, but just in general, cost segregation. There are a lot of misconceptions. I think one of the biggest, what I hear a lot, is that it's too expensive to do a cost segregation study. And that's really just not true. I mean, first of all, every company, including ours, will run a free estimate, so you can know ahead of time how much it's going to cost you and what the potential tax savings are going to be. So it's never going to be too expensive to get a free estimate. Okay. But there are some articles out there, back from like 2004, this Journal of Accountancy article that's floating around that people repurpose, that's saying like it costs like $20,000, $30,000 to get a cost segregation study done. And that may have been the case back in, 15, 20 years ago. But today it's not the case. I mean, obviously there's inflation and prices have gone up. Maybe it's maybe $5,000, $6,000 to get it on a property, but that's significantly different, right? If you're buying $1 million property and getting maybe $150,000, $200,000 tax benefit, it's a no-brainer to spend $5,000 to get that done.
Yes, 1,000%. And this is what I tell people too about, and most people, especially, our listeners and people in our field, we're all using CPAs at this point, but a lot of people, they're not using CPAs and not getting the full benefit of the deductions they could get, and they're like, oh, well, it's expensive, let's say it's $500, but if the CPA can somehow get you an extra $2,000 back, you've now netted $1,500. So that easily pays for itself, literally threefold. So, this is along those exact same lines where if you're able to get this, especially from the sponsorship side, where you're usually, especially if you're in the GP, you're usually a real estate professional or, at least headed that direction. So like you said, that's really benefiting you so much. And then ultimately passing that down to your investors. And as a passive investor, as you continue to grow as a passive investor, that's just more and more and more that you're able to take, and then eventually against the sale. So I guess kind of coming full circle now, kind of talk about this on the back end with the recapture and that kind of thing.
Sure. Yeah. I think another big misconception is this thing called recapture tax. Okay. Where a lot of people think and erroneously mention that, oh, well, if you take the benefits right now, you're just going to have to pay them all back when you sell. So you're not, it's going to wash itself out. And I think that is a huge misconception because, first of all, besides for the fact that you have the time value of money, meaning you have the amount, like you mentioned earlier, that having $1 today is worth much more than it is having $1 5 years from now. Not just because of inflation, which we know now, we're starting to understand how powerful inflation is, but just the simple fact that you can use that dollar, you can use that money now to reinvest, and the power of the compound interest that you can make from reusing that money. So that's one thing. The second thing is recapture tax doesn't even mean that you pay it back. It means that when you sell a property, whether you do cost segregation or not, you are subject to a tax called depreciation recapture. So it's similar to capital gain tax, where everyone understands that if you made a profit on the sale, you're going to be subject to a tax. You are going to have a capital gain tax on that amount. You're going to pay 25% tax or whatever on the amount that you made profit on. So too, the depreciation recapture says that the amount of depreciation that I took during the life of ownership, I'm going to be subject to a tax on that amount on the sale. So if you take more depreciation by using cost seg, for sure, you're going to be subject to a larger tax on that, but it's a gain. Okay. That's what it's called, a passive gain. And the reason why I say you're subject to the tax, as opposed to how other people like to frame it as you pay the tax, is because with real estate investing, if done right, you may not have to pay the tax even at that point, right? There's a very big difference between being subject to a tax and actually having to pay that tax, meaning obviously not avoiding it or anything like that, but there are strategies like 1031 exchange, which can defer that tax down the road, not just capital gain, will defer that recapture tax. There's also something called passive losses. So for example, if you do a cost segregation on a property and get all these passive losses, I mentioned before that they'll carry forward. Okay. So you may not be able to use them except when you sell the property. Well, guess what happens when you sell that property? Those losses get released. And so if you have enough losses, you can actually just offset that gain from that recapture tax. So you may not even have any taxable liability on that recapture tax upon the sale. There may be some, but again, if you have other investments or other losses from other properties, you may be able to balance it out. So just to clear up some of the waters, this is obviously not covering everything, but just so you know, there's more to it than meets the eye.
Interesting. Okay, so you've kind of alluded to some of the objections. What are some of those big objections? Because just from what you've told me and from the sponsors that I talk to, they seem to be very, this is what we're going to do. Is it, if I guess majority of their investors are IRA investors, maybe it wouldn't make sense, because it's already tax protected. Kind of
Yes.
talk about some of these objections and why it doesn't make sense, like, at all.
That's another great point. Yeah, if you are investing through a retirement account, which can be a great thing to do, great tax advantage. But if you're already in a tax shelter, right, through investing in that retirement account, like a solo 401k, a QRP qualified retirement plan, or a Roth IRA, if you're self-directing or investing through those formats, you're not able to benefit from the depreciation. So if you have a lot of investors do that, it may not make any sense to get, because if you can't benefit from the depreciation, there's no reason to get those deductions to do the cost segregation study. So that's one case where it really wouldn't make sense. Another case is if you really just plan on selling in a very short time. Now I mentioned there's the recapture tax, but having to deal with that literally from 1 year to the next, for example, it may just not make any sense, right? You're going to take those deductions now, and you're going to have that subject to that tax, deal with that tax bill the next year. It may offset it, may not. Obviously, the time value of money is going to be much less if you're not taking advantage of that. You have a much shorter window to take advantage of that. So those are a couple of reasons why it may not make sense.
Got it. Okay. Yeah, that makes total sense. Awesome. Well, listen, I would love to keep picking your brain all about this, but unfortunately we do have limited time. So now we'll just jump into the final 5 questions, just the last 5 questions that I love to ask all of my guests. So first one is the best advice that you've gotten from a mentor.
Best advice I've gotten from a mentor is really probably just pay it forward. Okay. So if you've gained success, there are others, just like I had a mentor that helped me in certain areas and taught me things and gave me, led me on the right path, lead others that way as well. And so that's why I just love adding value and teaching and using social media to just share so much and doing podcasts like this.
Absolutely. I love that so much. So what is it about your career, which I think we might know the answer here after what you just said, but what is it about your career that makes you feel like you're fulfilling your why?
Obviously, yeah, we did talk about this. It's giving back. It really is. Like, that's, to me, my why more than anything is just how can I help the most people possible? And so through the career that I'm in, every single person that I meet, like, I'm helping. Every single client that we have, I'm helping them save taxes. So that's helping them in a phenomenal way. I wouldn't even know how to quantify that. So that's extremely fulfilling.
Awesome. Okay. And what is your favorite non-real estate or investment related book?
Favorite non-real estate or investment relating book is a Jewish book that I love called The Way of God. It's a beautiful book written by Rabbi Moshe Chaim Luzzatto of the 18th century in Italy. It was written in Hebrew, originally been translated to English, but incredible book, just changed my life entirely. So definitely awesome. gotta mention that.
I love that very much. Okay. Are you familiar with the Marvel superheroes at all?
Maybe a few from like childhood.
Fair enough. So let's just take out Marvel. Let's just say if your personal investor avatar was a superhero, which superhero would it be?
I don't even know what any of them do, but yeah, I guess Superman. I don't know. Sure, why not?
That's a perfect one. Perfect one. Awesome. And last question: what's the best way for people to get a hold of you, reach out to you? They have more questions.
Yeah, you can find me on LinkedIn. That's the best way. I'm very active on that platform. Just mention that you listen to this podcast. I'd be very happy to connect there. You can also go to YonahWeiss.com, which is my website, talk about everything we're doing, both on the podcast side and the investment side, as well as cost segregation.
Awesome. Yonah, thank you so much. This has really been incredible. I learned a ton, and I know my listeners did as well. So thank you again very much.
My pleasure, Jonathan. Thank you for having me, and look forward to helping.
Absolutely. Hey guys, thank you so much for watching today's episode. I hope you really enjoyed it. Listen, I know it's cliche and you hear it all the time, but please don't forget to like and subscribe to the channel so you know when the next video is coming out. Even though this is technically a daily podcast, you know it's coming out the next day. We have a ton of content coming your way. So please like and subscribe. It helps a ton. Leave comments. Would love to know what you guys think. And we will see you on the next one. Thanks so much.